put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. What they found, hidden in the trash. In the spring of 1999, a company most Americans had never heard of was quietly suffocating under a secret weight that would crush everything it touched. First Brands Corporation, a name that meant nothing to Wall Street's glamorous elite, but everything to the millions who used their Glad trash bags, STP motor oil, and Prestone antifreeze. Behind the ordinary products sitting on supermarket shelves, a financial weapon was ticking. A debt structure so complex, so deliberately obscured, that by the time anyone understood what was happening, $10 billion in obligations had metastasized into a corporate death sentence. This is the story of how hidden debt doesn't just kill companies, it devours them from the inside out, leaving nothing but wreckage and unanswered questions. And at the center of it all was a man who thought he could outrun the numbers. Alfred Verrecchia didn't look like someone steering a company toward oblivion. As CEO of First Brands in the late 1990s, he presided over what seemed like a perfectly respectable empire of household names. Products so ordinary, so mundane, that no one suspected the financial architecture beneath them was constructed on sand. The automotive aftermarket division alone, STP, Prestone, Holtz, represented billions in annual revenue, distributed through every auto parts store from coast to coast. But revenue is just a number on paper. What matters in the dark side of business is what you owe, and to whom, and what happens when those debts come due all at once. First Brands had borrowed against its future, so aggressively, so systematically, that the future itself became a liability. The architecture of corporate debt is designed to be invisible. When you pick up a bottle of Prestone at your local AutoZone, you're not thinking about leveraged buyouts, credit facilities, or the complex web of obligations that connects manufacturing plants in Tennessee to banks in New York. That's exactly how companies like First Brands want it. The consumer sees the product. The investor sees quarterly earnings. But hidden in the footnotes of financial statements, buried in the language of credit agreements and bond covenants, is where the real story lives. First, Brands had accumulated debt through decades of acquisitions, buying up brands, consolidating market share, creating what Wall Street analysts called synergies. What they actually created was a ticking time bomb of balloon payments, variable interest rates, and cross-default provisions that would detonate the moment anything went wrong. The 1990s were kind to mediocre companies with good bankers. Credit was cheap, mergers were fashionable, and the stock market rewarded growth at any cost. First Brands played the game beautifully, on paper. They acquired the Simonis car care line, bolstering their automotive portfolio. They expanded internationally, pushing Glad and STP into emerging markets. Each acquisition added revenue to the top line, and each acquisition added debt to the balance sheet. Debt that didn't just sit there passively, but metastasized, compounded, demanded feeding. The business documentary of corporate greed often focuses on fraud or theft. But First Brands' story is darker because it's so common. Legitimate business decisions made by intelligent people, creating a financial monster no one could control. By 1998, the numbers were starting to whisper warnings that management chose not to hear. Operating cash flow was strong, the products sold well, margins were acceptable, but an increasing percentage of that cash wasn't going to shareholders or reinvestment. It was going to service debt. Interest payments alone consumed hundreds of millions annually. A silent vampire draining the company's lifeblood, quarter after quarter. But Wall Street didn't care, not yet. As long as the earnings releases looked clean, as long as management maintained their guidance, The stock traded sideways, and the credit markets stayed open. This is the corporate scandal that hides in plain sight. Not illegal, not even particularly unusual, just unsustainable. A company slowly drowning in obligations, while everyone pretends the water isn't rising. Then came the first crack in the facade. In early 1999, First Brands announced disappointing quarterly results, not catastrophic, just underwhelming. Revenue growth had stalled in key categories. Promotional spending was up, eating into margins. The automotive aftermarket, their crown jewel, was facing unprecedented pricing pressure from larger competitors like Valvoline and Pennzoil. In any normal company, this would mean belt tightening, maybe some strategic repositioning. But when you're carrying $10 billion in debt, a number so large it represented more than 4 times the company's annual revenue, disappointing results don't just disappoint investors. They trigger clauses, activate covenants, and set in motion a cascade of financial consequences that management can't stop. Here's what most people never understand about corporate debt. It's not just money you have to pay back. It's a set of promises, restrictions, and tripwires embedded throughout your business. Debt covenants require you to maintain certain financial ratios: debt to EBITDA, interest coverage, minimum liquidity levels. When your performance slips even slightly, you risk violating those covenants. And when you violate covenants, your creditors can demand immediate repayment of everything you owe. Everything, all at once. This is the financial mystery that destroyed First Brands. Not that they ran out of money, but that their debt structure gave creditors the power to accelerate repayment the moment things went sideways. By March 1999, First Brands was in technical default on portions of their credit facilities. The company that had seemed stable just months before was suddenly facing a liquidity crisis that could force bankruptcy within weeks. Behind closed doors, Alfred Verrecchia and his team were scrambling. They hired restructuring advisors, the specialized consultants who appear when companies smell death approaching. They negotiated with creditors, trying to buy time, trying to amend covenants, trying to prevent the acceleration that would sink them. But here's the brutal mathematics of over-leveraged companies. Once creditors sense weakness, they circle like sharks. Banks that had been friendly during good times suddenly became demanding, protective, suspicious. Every creditor wanted their money back before everyone else's, creating a race to the exit that guaranteed the company's destruction. This is the rise and fall business story told 1,000 times across American capitalism. The difference being that most people never hear about First Brands because trash bags and motor oil don't make sexy headlines. The solution, when it came, wasn't a solution at all. It was a surrender. In April 1999, Clorox Corporation announced it would acquire First Brands for approximately $2 billion, a price that represented a modest premium to shareholders, but was really about one thing: assuming responsibility for that crushing debt load. Clorox had the balance sheet strength to absorb it, the operational scale to justify it, the strategic rationale to sell it to their own shareholders. For First Brands' management, it was the only escape from a debt structure that had become a prison. The deal was announced as a merger, packaged with the usual corporate language about strategic combination and enhanced value creation. But make no mistake, this was a rescue operation, a lifeboat thrown to a company drowning in obligations it could never repay. What's fascinating about this business thriller isn't what happened to the brands. Glad still exists, STP still sits on shelves, but what happened to the capital structure? Clorox didn't just buy First Brands' products. They bought the entire debt pyramid, all $10 billion of it, and folded it into their own more sustainable financial architecture. The creditors got paid. The bondholders got made whole. The shareholders got their modest premium and went home. And the executives who had overseen the accumulation of that massive debt burden, they walked away with golden parachutes and moved on to other opportunities. This is the dark reality of wealth and power in corporate America. The people who create the problems rarely pay the price for them. But let's dig deeper into the mechanics of how this debt bomb was constructed, because that's where the real lessons hide. First Brands didn't wake up one morning carrying $10 billion in obligations. It was a gradual accumulation, each individual decision seemingly rational, each acquisition justified by projected synergies and market opportunities. When they bought automotive brands, they borrowed. When they expanded manufacturing capacity, they borrowed. When they needed working capital for inventory, they borrowed. Each loan had terms, conditions, interest rates, carefully negotiated by sophisticated finance teams. The problem wasn't any single debt instrument. It was the aggregate weight, the compounding burden, the way different tranches of debt interacted with each other through cross-default provisions and collateral sharing agreements. By the late 1990s, First Brands' balance sheet had become so complex that probably no single person in the company fully understood all the interconnections and potential cascade effects. And here's where the story gets truly dark. Management knew the debt load was unsustainable if growth ever slowed. The board knew that covenant compliance depended on hitting increasingly aggressive financial targets. The banks knew that First Brands was stretched thin, which is why they charged higher interest rates and demanded stricter covenants with each new credit facility. Everyone involved in this real-life business story understood the risk. They just assumed it was someone else's problem. Management assumed they could grow fast enough to outrun it. The board assumed management knew what they were doing. The banks assumed they'd be able to pull their money out before any collapse. This is the business crime hidden in legal contracts, the systematic transfer of risk from those who understand it to those who don't, wrapped in the legitimate language of corporate finance. No fraud, no theft, no obvious villain, just a collective agreement to pretend the mathematics didn't matter, until suddenly they did. The automotive aftermarket division is worth examining separately because it reveals how entire industries can become trapped in debt spirals. STP and Prestone weren't struggling brands. They had genuine market presence, loyal customers, consistent demand. But the aftermarket was consolidating, with major players like AutoZone and Advance Auto Parts gaining power over suppliers. These retailers could demand better pricing, extended payment terms, promotional support, all of which squeezed the margins of companies like First Brands. When you're carrying massive debt, you can't afford squeezed margins. You need every penny of cash flow to service those interest payments. So First Brands was caught in a vice. Retailers demanding concessions they couldn't afford to give. Creditors demanding cash flows they couldn't afford to sacrifice. The billionaire secrets of the automotive industry aren't about innovation or market disruption. They're about capital structure, negotiating leverage, and who controls the cash conversion cycle. There's a psychological dimension to corporate debt that business documentaries often miss. Debt changes how executives think, how boards make decisions, how entire organizations operate. When you're highly leveraged, you become short-term focused almost by definition. You have to hit this quarter's numbers, make this month's interest payment, maintain this year's covenants. Long-term strategic thinking becomes a luxury you can't afford. Innovation becomes risky because it might depress short-term earnings. Investment in people, processes, or capabilities gets deferred because the debt service comes first. First Brands in 1999 wasn't really a company making trash bags and motor oil anymore. It was a cash generation machine whose sole purpose was feeding the debt monster. The products were just the mechanism for generating the cash the creditors demanded. This is the hidden cost of leveraged business models. They transform companies from mission-driven organizations into debt-servicing operations that happen to have products. The Clorox acquisition closed in September 1999, and with it, First Brands ceased to exist as an independent entity. The headquarters in Connecticut was shuttered. The management team was absorbed or let go. The separate stock listing disappeared. A company that had operated for decades, that employed thousands, that generated billions in annual sales, erased, consumed by a larger competitor, specifically because it couldn't handle its debt obligations. But here's what haunts this story. Clorox made it work. They integrated the brands successfully, maintained market share, eventually paid down the debt, and turned the acquisition into a profitable part of their portfolio. The products were viable. The market positions were defensible. The problem was never the business. It was the capital structure, the debt load, the financial engineering that turned a healthy operating company into a bankruptcy candidate overnight. Let's talk about who really paid the price in this money and greed saga. Not the executives. Alfred Verrecchia and his team negotiated exit packages that ensured they'd be comfortable regardless of First Brands' fate. Not the creditors. They got paid in full through the acquisition, every dollar of principal and interest. Not even really the shareholders. They received a reasonable premium over market price. The people who paid were the employees who lost jobs in the post-merger integration, the communities that lost corporate headquarters and local tax revenue, the suppliers who'd built businesses around First Brands' purchasing power and suddenly found themselves negotiating with a much larger, more demanding Clorox. This is the systematic wealth transfer that debt-driven corporate strategies create. The benefits accrue to financial players, bankers, investors, executives, while the costs get dispersed across workers, communities, and smaller businesses with no seat at the negotiating table. The financial mystery at the heart of First Brands isn't really mysterious at all once you understand the incentives. Why would management take on so much debt? Because debt-funded acquisitions create the illusion of growth, which drives stock prices up, which triggers executive bonuses and stock option gains. Why would banks lend so much to an over-leveraged company? Because lending is their business, and they could charge premium interest rates and secure their position with senior claims on assets. Why would boards approve increasingly aggressive leverage? Because directors are often selected for their willingness to support management, and challenging a CEO's strategy risks conflict and removal. Every actor in this corporate scandal was responding rationally to their personal incentives. It was the collective outcome that was insane. A profitable business destroyed by financial engineering because no one had the incentive to say, "Stop." Today, if you buy a container of Glad trash bags or a bottle of Prestone, there's no trace of First Brands on the packaging. The name has been erased from history, absorbed into Clorox's corporate identity, as if it never existed. But the lessons, or the warnings, remain relevant because this pattern repeats constantly in modern capitalism. Right now, somewhere, there's another company borrowing against its future, another management team convincing themselves they can manage the debt, another board approving another credit facility because growth demands it. The stock market secrets aren't secret at all. Debt amplifies returns when things go well, but it amplifies destruction when they don't. The mathematics are clear, predictable, merciless. What changes is only the names of the companies, the specific industries, the faces of the executives explaining why this time is different. The entrepreneurship secrets embedded in First Brands' collapse are counterintuitive but critical. Sometimes the path to building lasting value is saying no. No to acquisitions you can't afford. No to growth that requires unsustainable leverage. No to the siren song of easy credit and financial engineering. The companies that survive aren't always the ones that grow fastest or borrow most aggressively. They're the ones that understand their businesses well enough to know what level of debt they can actually service through economic cycles, competitive pressures, and unexpected shocks. First Brands failed that test, not because they were stupid or malicious, but because they optimized for quarterly results and stock price appreciation rather than long-term sustainability. They played the game everyone else was playing in the late 1990s. They just ran out of time before they could find an exit. There's a final, darker chapter to this story that rarely gets told. After Clorox integrated the First Brand's portfolio, they eventually sold off pieces of it. STP went to one buyer, other automotive brands to another, parceling out what had once been an integrated automotive aftermarket empire. The brands still exist, still generate revenue, still sit on shelves. But they've been financially strip-mined, restructured, bought and sold multiple times, each transaction extracting value for investors, while the brands themselves remain fundamentally unchanged. This is the real business model of modern corporate finance. It's not about building better products or serving customers more effectively. It's about structuring and restructuring ownership claims, using debt and equity to capture value that the operating business creates. First, brands died so that its brands could be harvested, divided, and monetized by parties with stronger balance sheets and better access to capital. So here we are, decades later, examining the wreckage of a company most people never heard of, telling a dark business story about trash bags and motor oil that somehow contains the entire architecture of modern corporate capitalism. The $10 billion debt bomb didn't explode. It was carefully diffused by Clorox, its components disassembled and integrated into a stronger structure. But the bomb was real, the threat was real, and the lesson remains urgent. Hidden debt doesn't just kill companies when it's discovered. It kills them slowly, invisibly, long before anyone admits what's happening, by consuming the resources and strategic freedom needed to adapt, compete, and survive. First Brands' collapse wasn't a dramatic explosion. It was a slow suffocation, a gradual crushing under weight that everyone could see but no one could escape. And somewhere tonight, in a boardroom you'll never see, executives are approving another credit facility, taking on another layer of debt, convinced that they're different, that they've learned from history, that their debt bomb will never detonate. They're probably wrong. They usually are. Subscribe and listen to our next story below.